The head and shoulders pattern is said to be one of the most reliable and statistically successful patterns to trade. It's said it has a success rate of 70 to 80%. In this lesson, we will discuss what the head and shoulder pattern is. Then we will discuss the recommended strategy that a trader should take when this pattern has formed. Then we will go over a step-by-step guide on how a trader could actually trade this pattern in real life. First, let's start with identifying this pattern. A head and shoulders pattern is a technical chart pattern that appears as a baseline with three peaks, the middle one being the highest, resembling a left shoulder, head, and right shoulder. The neckline is the level of support that connects the troughs between the shoulders and the head. Now, let's move on to how to trade this pattern. There are two ways to trade a head and shoulders pattern: the conservative approach and the aggressive approach. The conservative approach involves waiting for the neckline to be broken before entering a trade. The neckline is a significant level of support, so when it is broken, it signals a change in trend. Traders who use this approach typically wait for a retest of the neckline before entering a trade. This helps to confirm that the neckline has indeed been broken. The aggressive approach involves entering a trade before the neckline is broken. Traders who use this approach typically enter a trade when the price breaks below the neckline of the pattern. However, this approach is riskier, as there is a higher chance that the pattern will not play out as expected. It is important to note that not all head and shoulders patterns will result in a reversal of trend. Sometimes the pattern may fail to play out, and the price may continue in its previous direction. Based on the head and shoulders pattern on the XYZ stock chart, we can look for a potential short selling opportunity. Here's a scenario on how to possibly approach this trade. Entry. We typically wait for the neckline to break before entering the trade, which in this case is at $100. So we could place a sell limit order at $99 or $98.50 to ensure that we get filled once the price breaks below the neckline. Stop order. We want to limit our potential losses if the trade goes against us, so we would place a stop loss order above the peak of the right shoulder, which is at $102.50 or $103 to give the trade some breathing room. Target. We can estimate the potential target of the head and shoulders pattern by measuring the distance from the top of the head, which is at $106, to the bottom of the neckline, which is $100. This equals $6 in distance. We would then subtract this distance from the neckline to get the target. So we could place a limit order to buy back our shares at $94, or slightly above to ensure that we get filled. Nice trade. Congratulations. You now know the fundamentals of the head and shoulders pattern and how to trade it. Of course, it's important to keep a close eye on the chart and adjust our orders accordingly as the trade progresses. It's also important to consider any news or events that could affect the stock's price and adjust our strategy accordingly. By following a clear plan and using risk management techniques, we can increase our chances of success in the markets. Now, try practicing on a chart. Open up a chart and put the time frame on daily and to look back max length. Zoom in and start finding those head and shoulder patterns. I'll see you in the next lesson.
Hey everybody, it's Scotty here. Listen, I want to share something with you. Before you become a trader, you must first become a chartist. So go on to our website at 10xcharting.com and explore our courses to become a real chartist and a real trader.